Hey everyone, this is Bergman, founder and CEO of IRA Financial. Welcome to another episode of AdBits, where I will be sharing bits of knowledge about self-directed retirement. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of AdBits. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's episode, I want to talk about what are the benefits of the solo 401k plan. So this is a really important podcast if you are self-employed or if you have a business, could be part-time or full-time, with no full-time employees, meaning you have a business that has no non-owner employees that work over 1,000 hours. The solo 401k is the best plan for the self-employed. It is a gem, okay? Unfortunately, not enough self-employed individuals know about it, okay? So I'm going to spend some time talking about the benefits. And listen up, because this could make a monumental difference in the amount of money you have when you retire. And that's just a fact. So I will start this podcast with a bold statement. If I could, I would put every single client of mine, all 23,000 or so clients, into a solo 401k versus an IRA. Okay, let me just say that again. I would put every single client I have in a solo 401k versus an IRA. Okay, so I'm going to let that kind of marinate. Why? I'm going to go through the reasons. One, let's talk about the most important part. Contributions. Maximizing the amount you can put in a 401k and taking advantage of the power of deferral. So with an IRA, you can only put away $6,000 or $7,000 if you're over 50 in 2021. For a solo 401k, you can put away $58,000 or $64,500 if you're over 50. So right there, you can see the difference. Almost 10 times the amount you can put into a 401k versus an IRA. So that's the huge first glowing advantage of the solo K over an IRA, right? The more you put away, the more you are going to be able to save. And the more, hopefully, if you do a pre-tax contribution, you'll be able to maximize your tax deductions. So that's the first, okay? The IRA contributions are dollar for dollar, $6,000 or $7,000. You need to have some earnings. Solo 401k broken into two components. There's the employee deferral, which is dollar for dollar, $19,500 or $26,000 if you're over 50. And then the profit sharing, which is a percentage of your salary, 20% if you are Schedule C or single member LLC, 25% W-2. For example, you made $40,000. If you had an IRA, all you can put in is $6,000 or $7,000. If you had a solo 401k, you can put away, if you're under 50, $19,500, dollar for dollar, and then either 20 or 25% of the 40, depending if you have a C Corp, S Corp, which is 25% of the 40, or a single member LLC or sole proprietor, 20%. Okay, so just let's keep it simple. Sole proprietor, you make 40 grand, you want to max out your contributions. Under 50, $19,500 plus about $8,000, giving you $27,500 out of the 40, meaning you're paying tax only $12,500. The rest goes into the 401k instead of paying Uncle Sam. Okay, so that's obviously a monumental advantage that you have. Now imagine you're able to do that for 20, 30 years. You can understand the enormous potential you can have, right? Let me just tempt you with some numbers. Let's say you just put away $10,000 a year. Forget about the 18.5, the 19.5, the 26. And let's say you do it from age 35 to 72, okay? And let's say you get an 8% rate of return, okay, which is a little, that's reasonable. Guess what? You're gonna have $2.1 million when you hit 72. Not bad, right? Let's say you say, well, Adam, 35 is a little young. Maybe I'll start at 45, okay? You'll still have over $900,000, 910. Let's say instead of 10 grand, and again, this is just saying 10,000 flat. This doesn't take into account that you 1 year may put in a little bit more. Let's say instead of the 10, you do 15,000 a year, okay? And let's say you, we'll say you do this from age 45 to 72, 1.3 million. Let's say you did it from age 40 to 72, almost 2.1 million. Let's say you did it from 33 to 72, 3.7 million. So you see what's going on here? Here's the theme. The earlier you start, be consistent, trust the process, you will have millions of dollars when you retire. So the 401k gives you that advantage over the IRA because you can just put away a whole lot more, and it's based off math. The more you put away, the more you're going to have, irrespective of whether you buy mutual funds, ETFs, stocks, cryptos, real estate, hedge funds. It should average up between 6 and 8%, 6 and 10%. So you're going to be fine. And I'm more focused, even though I'm in the alternative asset business, fintech business, helping people take advantage of the rules and invest in alternative assets. I don't care. I don't make money where people invest. So if you say, Adam, I feel more comfortable buying mutual funds, ETFs, do it. All good. Just save. Okay, that's the first advantage. Obviously, put away a whole lot more, almost 10 times with a solo K. Number two, you can borrow up to $50,000 from your 401k. With an IRA, you can't borrow a penny. The rules are, in a 401k, so long as your plan documents allow for it, you can borrow $50,000 or 50% of your account value, whatever's less. So if you have 100 grand in your plan, you can borrow 50K. If you have 20 grand in your plan, you can borrow 10. Now here's the catch. You can use the funds for any purpose, anything. Paying off debt, going on vacation, buying yourself a car, a watch, whatever you want. Number two, you're paying yourself back. The money is going back into your plan. Lowest interest rate is low, 3.25%, which is prime. And it's a 5-year term. So you have to pay back at least quarterly, but you can do it bi-weekly or weekly or monthly. So at least 4 times a year, minimum interest rate of 3.25%, pay it back over 5 years. You can use a higher interest rate if you wish, if you want to push more money back into your plan, and you're paying yourself back instead of a credit card. So that's the second big advantage. Third, like an IRA, you can do alternative asset investments, right? You can do real estate, you can do cryptos, you can do stocks, mutual funds, ETFs. Same prohibited transaction rules, except with a 401k, you can buy life insurance. An IRA, you can't. Otherwise, you have the same investment options. 4, if you're a real estate investor, there is a huge benefit to go solo over an IRA. And that is if you love leverage, which who doesn't love leverage? Who doesn't love using other people's money for free? Well, you could in a 401k. Let me explain. If you get a non-recourse loan with a retirement account, and it has to be non-recourse, you cannot get a traditional personally guaranteed mortgage if you use a retirement account to buy real estate. Why? Because the tax code under 4975 says you cannot personally guarantee an obligation of your IRA. That means it has to be a non-recourse. A loan you do not personally guarantee. If you did it with an IRA, you're going to pay something called unrelated business taxable income, or UBIT or UBTI, on more than $1,000 of net income associated with that investment. If you did it in a 401k, there's an exemption under 514c9 that allows a 401k to use a non-recourse loan for real estate acquisition indebtedness and not pay any UBTI tax. Huge advantage if you are a real estate investor and love using other people's money, which OPM, who doesn't love OPM? So listen up, it's a big opportunity. A lot of investors don't know about this fact that the 401k world has this exemption from the UBTI tax. And let me give you an example of how it works. So let's say you have 100 grand in an IRA or 401k and you need to buy something worth 200. You don't have enough cash. We know you can't use money from a personal account and retirement account. It's a little bit risky based off the self-dealing rules. What do? Well, you go to a bank. You say, okay, I need money. I'm putting 50% down. So a lot of banks, non-recourse lenders, will give you that 100K. They'll charge you a little bit more of interest because it is non-recourse. They are taking somewhat of a bigger risk because there's no personal guarantee, but you're putting 50% equity down in this case, so they'll give you the loan. And now, let's say the investment generates $10,000 of net profit after expenses like debt servicing, depreciation, improvements, other expenses. The UBTI tax would tax it approximately, let's say 37%. That's the maximum tax rate. So that $10,000, let's say you're going to pay 37% tax, right? You're losing $3,700 that your IRA needs to send to Uncle Sam. If you did that in a 401k plan that had the ability to buy real estate as an option, then you can have that $10,000 after depreciation, after expenses, and pay zero UBTI tax. So you're saving 37% tax, gaining the ability to leverage up, use other people's money, buy more real estate, make more money. It's just a really, really superb opportunity. That's another major advantage of the solo K over the IRA. Other is asset creditor protection. In bankruptcy under the federal 2005 Federal Bankruptcy Act, there's no limitations for 401ks in bankruptcy. Generally, it's protected. IRAs, there's a million plus or so threshold. So, not super relevant. Not everyone has over $1 million. And then outside of bankruptcy, if you have creditors that are after you personally, most states give 401ks greater creditor protection than IRAs. So another little advantage. 401ks does not have a solo K as a very, very simple administrative responsibility. If you have less than $250,000 in your plan, you actually have no reporting requirements with the IRS. And if you have greater than $250K in your 401k plan, as of 12/31 of the prior year, you simply have to file a 5500 easy. And it really is easy. It's only 2 pages, 10 questions, takes no longer than 5 minutes to do, and we will assist you. So really simple administration. Most of all, you can serve as the trustee of the solo K. If you get a self-directed plan, for example, through IRA Financial, you can do stocks, mutual funds, ETFs, and also alternative asset investments as the trustee and have total control, make high contributions, maximize deductions, do Roth contributions, conversions if you'd like in the plan, buy almost any asset investment you wish, do a loan, borrow up to $50K, tax-free, penalty-free, use it for any purpose, simple and easy admin. It's really an unbelievable plan. Again, if I could, I'd put every single one of my clients in a solo K or an IRA. Unfortunately, why don't I? Not everyone is self-employed. Not everyone has a business. And again, it doesn't have to be a full-time business. It just needs to be a business, whether you sell shoes on eBay or you sell something on Amazon or you are a math tutor or you do some consulting, whatever it is, as long as you have some Schedule C or you have a business that has some business income and you have no full-time employees that work over 1,000 hours that are non-owner. So let's say Adam and my wife own a business, because wives are not deemed employees, believe it or not, for ERISA purposes. So if me and my wife own a business, and let's say it's a part-time business, we sell creams on Amazon, make a little bit of money, not a lot, but part-time. I have a job, she has a job. We have no full-time employees other than ourselves, just us. We can set up a solo K and defer money from our business into our plan. We can also potentially do a Roth IRA or a regular IRA depending on our income levels. So it's a great way to maximize your retirement savings. It's super robust. It gives you investment diversification, loan feature. You can use some of those funds to even finance my business growth. Really, really positive elements to it, and really nothing compares to it. I love self-directed IRAs. They're great if you're not self-employed, but the solo K will let you do the same you can do from an investment standpoint as an IRA, but gives you that loan feature, higher contributions, better asset and credit protection, and just that loan too, that $50K loan, which comes in handy. We all have cash flow issues, right? Every one of us. So it's nice to have a little bit of money you can tap into, tax-free, penalty-free. So there you have it. Those are the benefits for opening a solo K, which is not a new plan. It's simply a 401k for someone that has no full-time employees other than themselves, a spouse, or other owners. So even if you have a little accounting firm, which is 2 or 3 partners, no non-owner employees that work more than 1,000 hours, 1099 contractors do not count as employees. Okay, so if you hire someone to do your IT or whatever on their 1099, that's good. It's not going to disrupt the solo 401k eligibility rules. So lots of opportunities, lots of options. If you're self-employed, part-time, full-time, small business, no full-time employees other than yourself, a spouse, or other co-owners, think about going solo. It makes a huge difference, right? Those numbers I mentioned, it makes a huge difference, right? Again, let's go back to those numbers, kind of end on that. I think people may not trust me, but you're going to trust math. $10,000 a year, right? Let's say even if you do it from 50 to 72, 8% rate of return, $578,000 tax-free, right? You get the deduction for the $10,000. If you do it in a Roth, you don't get the deduction, but that $578 would be tax-free. Now let's have one more example, and let me have some fun with this. Let's say you start at 26, okay, 10 grand a year to 72, 8% rate of return. You're gonna love this, 4.3 million tax-free if you did it in a Roth. 10 grand, I know it's a lot of money. I'm not saying 10 grand is not a lot. Less than $1,000 a month, it's doable. Okay, it's not like $1 million a year. It's 10 grand a year, 26 to 72, $4 million, 4.3 million. Let's say I can't do it at 26. Let me start at 31. Okay, 2.9 million tax free. It's good. Yes, time value of money, 2.9 million today may not be what it's worth 40 years, but it's still money. Okay, it's still going to have some value. I'm 45 years old. $1 million today is still worth something. $1 million in 1975 was worth more. But $1 million today still has value. You could still do a lot with $1 million. We're generally in a very low inflationary period. It probably is going to continue for some time. Even if there is some robust short-term inflation because of COVID, it will stabilize. So bottom line, time value of money will not be an issue, I think at least. And even if it is, it's still free money. Do it. Be consistent. If you're self-employed, consider yourself lucky. You are blessed. You can take advantage of the powers of the solo K, maximize your retirement contributions, your deductions, take advantage of the power of tax deferral, invest in assets you know and trust, even get that $50K loan feature. Super, super attractive and could make a humongous difference as you grow older, retire, and honestly leave a lasting legacy to your family. All for just setting up a basic little solo 401k, putting away money each year. It adds up. I promise you, it adds up. I've seen it. It adds up. Just do it. Yes, it takes time. Yes, you are doing something for your future, for your family, but it works. It's based off math. That's why this is so great. It doesn't matter what your religion is, what your color of your skin is, whether you're a Democrat or Republican, where you live. It's just math. It doesn't matter if you invest in mutual funds, ETFs, cryptos, real estate. Just get between 6 and 10%. Watch your money grow. You will be rich. If you're self-employed, you have a huge advantage, right? Think about this. Last thing I'll leave you with. You work at Google. Okay, you do well. You make 100 grand a year. Let's say you make 200 grand a year. You put 19.5 away in your 401k. Google's only going to match you 4 to 6% of that of your 200 grand. So another 8 or so grand. If you're self-employed and make 100 grand, you can go 19.5 plus 20% of your 100. So you can put away 39, a lot more than you would even if you work at Google, right? Which is one of the biggest companies in the world, all these benefits and fringe benefits and all these great stuff. But you can actually save more if you're self-employed. So consider yourself lucky. You obviously probably are going to be successful. You're doing what you want. You have control over your life, over your future, and you can maximize your retirement savings. So there you go. That is the reason why I would put every single one of my clients, if I could, in a solo 401k. If you are self-employed, hopefully I've convinced you to at least consider starting to save. If you are saving already and you're doing it in a SEP IRA or a simple IRA or just a regular old IRA, hopefully I've at least piqued your interest in the solo, which is a more robust plan than the aforementioned IRAs, SEPs, and simples for the reasons I mentioned. So hope you guys enjoyed it. I did. Love talking about solo 401ks. Love talking about all the potential opportunities the small business community and self-employed individuals have to save for retirement. It's a hidden gem, but you actually are in a better position from a retirement standpoint if you're self-employed than if you're a big shot working in Silicon Valley, believe it or not. So stay safe. Subscribe if you haven't. Really appreciate the support. Subscribing supports me, keeps me going, makes me know that there's people out there listening, watching. If you're watching on YouTube, definitely subscribe to our channel. I think you'll really enjoy it. we drop 5 videos, and we also post our 3 My podcasts. So IRA Financial channel is where you should go. If you're listening to podcasts, then just keep doing what you're doing. I'll keep bringing it. Thanks for your support. Keep safe, and talk to everyone again soon.